How does the Marginal Standing Facility, MSF, primarily support liquidity management in the Indian banking system? By influencing the overnight lending rate, by influencing the long-term interest rates, by influencing the inflation rate, by influencing the repo rate, by influencing the overnight lending rate. Explanation. The Marginal Standing Facility, MSF, is a window available to scheduled commercial banks to borrow overnight funds from the Reserve Bank of India, RBI, against government securities. The MSF rate is typically higher than the repo rate. When banks face an acute shortage of liquidity, they turn to the MSF. By setting the MSF rate, the RBI essentially creates a ceiling on the overnight lending rate. Banks are unlikely to borrow from other sources at a rate higher than the MSF rate, as they can always access funds from the RBI at that rate. Therefore, the MSF directly influences the overnight lending rate in the banking system by providing a backstop lending facility. Why other options are less suitable? It primarily deals with very short-term borrowing and does not significantly impact longer-term borrowing costs. While monetary policy actions have implications for inflation, the MSF is a direct tool for managing immediate liquidity pressures and has a less direct impact on general price levels. The MSF rate influences the overnight lending rate, while the repo rate is the rate at which commercial banks borrow money from the central bank by selling securities with an agreement to repurchase them at a later date. MSF is specifically designed for emergency liquidity needs and operates distinctly from the repo rate, even though both influence short-term liquidity.